Welcome to Vishal and Company, where Equity Guru's own Vishal Tura, Taku Ndachena, Colin Botrell, and Maddie Grace examine the week's financial events in real terms, bringing the esoteric blur of public market activity into sharp focus. So come in, sit down, put your feet up, and enjoy.
All right, welcome back, everyone, to this week's edition of Vishal and Company. This week, Vishal is going to give us some quick weekly market updates, talk about Biden's pick of Janet Yellen as his Secretary of Treasury, which he seems excited about. In our notes, he writes, "She's back!" exclamation point. Janet Yellen is back. So that's good news, I think. What the second wave of job layoffs in the U.S. mean for the market and how the Fed is split on a response plan. And lastly, he's going to touch on short trading gold, oil in regard to the COVID vaccine, and Bitcoin reaching new highs. TK is going to give us an update on the big banks, Scotia, RBC, and TD. And lastly, Colin's going to chat about the big movers of the week. I'm the resident not finance person to keep all these guys in check when they start making not a lot of sense for my non-industry friends tuning in. All right, Vishal, all yours.
All right, thank you. And just before I begin, I'm really excited to hear TK's talk about the Canadian banks because, believe it or not, I'm looking to add one to my portfolio. So that will be a good discussion. On the market front, it was a shortened week. Thanksgiving in the U.S. So for our American viewers here, happy Thanksgiving. So the markets were closed. The American markets were closed yesterday, which is a Thursday, and they are actually currently closed today because today was a half day. So markets were closed at 1 p.m. Eastern Standard Time or 10 a.m. Pacific Standard Time. As you can see, the week started off really bullish, right? So this is Monday's candle, Tuesday's candle, and then, of course, Thursday, the futures are still open, but there really was no volume. And then today on the half day, we are now coming back to test the highs here on the S&P. So just, one of those, I want to say like a dull week because there was still a lot of individual stocks that moved. For example, a lot of the tech stocks are finally coming back. Tesla, of course, our favorite, one of our favorite companies here, almost hit $600 a share today, but is beginning now to, hopefully get a bit of a pullback because, again, nothing moves up forever. And then the other big story today was actually Palantir and Citron Research putting out a value or a target of $20 per share. And if you guys don't know about Citron Research, they are a well-known and popular short seller. So they're saying that Palantir is not a stock anymore. It's actually a casino, and the casino needs to pull back to get back down to $20 by the end of the year. So you can see here, did sell off a little bit, but the NASDAQ itself is still quite strong because a lot of the other tech stocks began to move. I think, Shopify and Amazon are the ones a lot of people are moving into, just front running Black Friday, Cyber Monday, and likely this is going to be the largest revenue that these companies make for online shopping, obviously due to COVID. But I'm still hearing that a lot of the malls and stuff are still full. I'll go find out after the show. I'm going to be the man on the ground, do some investigation for myself. The Dow Jones. So once again, very similar approach to all these markets, shortened week, but they are ending the week quite strong here. The way we started off was Janet Yellen. That was the news that she's back. So, of course, Janet Yellen was the first female Federal Reserve chairwoman during the Obama administration for 4 years. And now she's in the running, or basically, you can see that the Chinese don't like her apparently, but she's in the running now to be the Treasury Secretary. So she's going to be the first person in history to be in charge of the Federal Reserve's balance sheet and now the government's balance sheet. So she was known to be for being a super dove, really dovish. On my front, she was quite a dull person to listen to. So like the Fed conferences were a bit boring. She sort of had a bit of a monotone voice, and people were actually happy when Powell came on board because he actually brings some excitement to some of these conferences. But the market loved her, right? Because she is a super dove, although what that means, as a Treasury Secretary is, again, more easy money, likely more money printing.
Vishal, sorry, one sec. What are you saying? Super dove?
Yeah, so a
Like
super dove, there's in central banking, there's two terms for central bankers. One is called a dove, and one is called a hawk. So hawkish and dovish, and generally what that means is when a central bank is hawkish, they're planning to raise interest rates and try to, tamper inflation. When basically they're being bullish or bullish in terms of central bank policies, right? That they are going to increase interest rates. Whereas a dove is someone that I guess you could say is bearish on the central bank policies, where they're planning to keep interest rates low and cut interest rates, keep them low for a very, very long time, right? So, people remember Yellen was a super dove. During the Obama administration, he had, of course, 8 years of negative interest rates, and sorry, not negative, 0% interest rates, and also not one, not two, not three, but 4 rounds of QE. But again, now she's going to be a Treasury Secretary, so it's going to be a bit different. But the market did like her that news, because obviously she is likely going to carry that stance. She's actually quite famous by traders, because she was a woman that said that she doesn't foresee any financial crisis in her lifetime. So that one sort of, I guess, bit her on the back. But that's what she was sort of famous for, and like that's what she meant, right? Central banks would do everything to prevent any crises, as even if it meant printing much more money and all that kind of stuff. But the other way to look at the market, and we'll look at that when we talk about oil, is of course the vaccine news. But before we look at oil, gold, and Bitcoin, let's just look at the fundamentals here. So if you guys recall, last week, the US jobless claims rose to a 5-week high. So before last week's jobless claims report, the jobless claims number was coming lower every week. So people were saying, oh, okay, people are going back to work. Not many people are being laid off. However, there was that danger that this week's jobless claim number would rise and would indicate now that, we're probably going through a second wave of lockdowns. And believe it or not, we did get another higher reading for the jobless claims. So now we have 2 jobless claims in a row rising. You know what they say, 1 time's random, 2 times a coincidence. The 3rd time it becomes a pattern. So we'll watch for next week's jobless claims, and that would maybe indicate if this second wave of layoffs are now beginning. On the central bank news, I think this is something that's not really surprising, but I think we'll get a good laugh at this. But the Fed had their FOMC minutes on Wednesday. They talked about how they're going to be increasing their bond purchasing program, which I don't think people are too surprised about. But this is an interesting note, and I think we can maybe discuss a bit about this. But some members of the Federal Reserve Board said that several participants noted that the possibility that there may be limits to the amount of additional accommodation, so essentially, buying programs, that could be provided through increases in the Federal Reserve's asset holdings in light of the low level of longer-term yields. And they expressed concerns that a significant expansion in asset holdings could have unintended consequences. So, those unintended consequences could be bubbles, perhaps, stock market bubbles, other asset bubbles. So I think this is a bit of an interesting little point that was laid out. But again, we don't think they're going to stop anytime soon, because as soon as that came out, they still did say that they are planning to increase their bond purchasing program. Anyone have any thoughts about that?
Yeah, I do actually. There's a guy in America, Howard Marks. He's a famous bond investor.
Yep.
And he was, I think it was on Bloomberg not too long ago, maybe a week or two. And he was talking about how they, as a fund, haven't bought any bonds, corporate bonds, in the last few quarters, because he's seeing mostly bubbles in the junk bonds. And he actually started noticing a lot of people buying put options on these bonds.
Wow.
So making bets that the bonds will decrease in value as well. And it's pretty it's a pretty popular trade right now for a lot of the bigger funds, where they're shorting some of the junk bond ETFs or specific company junk bonds.
So are you saying that they're betting against the Fed?
They're betting against the Fed being able to continuously buy a certain amount of corporate bonds, leaving away. So the Fed has to buy a certain quality of bonds.
Yeah.
So their bet is the junk bonds will not be bought, and if they do buy it, we know that they're putting excessive measures to keep the bond market stabilized. So it's an interesting bet, and he's been, I think, buying. He's only a bond investor, so we've been watching it for close to 30 years now.
Now, my question is BlackRock and State Street going to have a huge influence on what the Fed is buying?
I believe it is BlackRock that is running the bond purchasing program for the Fed.
Yes, and State Street is providing some advisories on their corporate bond buying as well. So really, who is in charge of the market? Is it the Fed or is it these big asset management houses?
It's the guys managing trillions of dollars. They basically do move the market, and traditionally, the Fed would go through the banking system to actually allow money to come in or money to come out through deposits with the banks. But that doesn't work today, or it hasn't worked as of late. The last time they did try it was in 2008, when they issued preferred securities to a lot of the US banks to try and increase liquidity. And some of the banks, it did well, but a lot of the banks did fail, some of the smaller commercial banks. And around this time, the Fed is trying to find alternative ways to get access to the market to quickly deploy money, rather than allowing banks to use the trickle-down effect that it usually does. So it's an interesting time to see asset managers interacting with the people who are supposed to be the watchdogs over the market.
Not sure if you guys saw this, but this came out yesterday. But we all know Bank of Japan, the Central Bank of Japan, is buying stocks, and they actually racked in a $56 billion gain after boosting investments by buying stocks on the Japanese stock market. So the Bank of Japan and the Swiss National Bank are probably some of the best performing hedge funds right now in the world.
Apparently, the Bank of Japan is using the software made by BlackRock to do all their purchasing.
There we go. Yep, BlackRock. So I did put a picture of Larry Fink or Lawrence Fink. So yeah, a lot of people have been saying that this is the guy, right? So he is the CEO of BlackRock. BlackRock are the ones managing the Federal Reserve, and as Galen just mentioned, now the Bank of Japan is also.
The big three in the United States, just so everybody knows, if you want to know who actually runs the stock market, the big three, this would be BlackRock, State Street, and Vanguard, or all own at least 5% of 97.5% of the companies on S&P 500.
There we go.
Gone are the days of being taught that the central bank is the lender of the last resort. I feel it's more appropriate to say it's the broker of last resort. That's where it is now.
Right. So speaking about central bank failures, gold always pops up as that, alternative asset. And one of my, I would say, maybe least popular trade ideas on Equity Guru's Market Moment has been a pullback to $1,800 on gold, which actually did happen. Finally, I did post that idea in August, and it took some time. I mean, it took a few months, but we did touch 1,800 just a few days ago. But as you guys can see, what I was looking for was a bit of consolidation here. As you can see with these 2 days of price action, price was battling at 1,800, and we were expecting some sort of bounce at this level. But look what happened. We actually broke down. We closed below, and now I'm actually looking at this level here, 1740 to 50. This is also what our mining expert, Greg Nolan, posted in our Discord channel, that he thinks gold is going down to around 1740. But I must say there's also a really big flip zone here at 1675. So it looks like gold has one more leg lower here. I just want to give you guys quickly what I'm watching for in terms of that gold, pop eventually. And it does have to do with silver. This was also in July. I did post about how I think silver will eventually come back down to $20.50. And once that happens, I believe that will be the last time that we will have the opportunity to buy assets such as gold and silver at these cheap prices. And to tell you the truth, folks, silver still has not broken down yet. Gold is breaking down, silver has not. I do think silver still needs to pull back here to 2050. So that's why I do foresee a bit more move lower here in gold. And, again, gold can move down here to 1740, and silver can do this in one day, right? Because silver is gold on steroids. When silver does sell off or move up, it does tend to outperform gold, right? So I am watching this $20-50 zone. A few of us on the Equity Guru trading room, the Discord trading room, actually did take short positions on gold, on silver, front running this eventual breakdown here. But the one thing that I want to mention to the group here, and maybe even TK, I know you'll probably have something to say with this, but gold is down, silver is down, but also the US dollar is down, right? So I know a lot of the gold bugs are going crazy right now because generally there's that negative correlation between gold and the US dollar. When the dollar is moving down, people expect gold, which is priced in dollars, to be going back up, right? So there are two things that people are looking at here. Either this means we are on a risk on environment, and what I mean by risk on versus risk off is related to the stock market. So in a risk off environment, people tend to buy safety assets such as gold, such as the dollars, such as bonds. And in a risk on environment, people tend to sell those assets and move into riskier assets such as stocks. So that's one way to look at this. We're seeing the dollar drop, we're seeing gold drop, we're seeing silver drop. And when I talk about oil, it'll start to make sense because there is a vaccine rollout, which might be occurring as early as next week in the States. But the other idea is obviously, and some viewer mentioned this last week, a price manipulation, right? Maybe in gold and silver. I tend to look at it right now currently as this risk-on environment. So a lot of people are selling off gold and silver and the dollar. And I think it's to do with that vaccine rollout. Just a few days ago, yesterday, on the Equity Guru website, I wrote a market idea here on oil. And I said, is oil is the true COVID vaccine play? What I mean about that is we did get this breakout on oil at $44 here. We've been ranging in between $44 to $35, let's say it, since June of this year. Really nothing has happened until we broke out on the 24th of November. And as you can see, I already have the pattern drawn out here. I was hoping for a pullback to retest that zone before we move higher. But another alternative is if we actually break back above $46, I will myself go long on oil. And people are saying that this is the COVID vaccine play because it is pricing in no further lockdowns. As you guys remember, when we did lockdown before, and of course, we can make different sort of comparisons now because at that time when oil sunk to $0, it was really the whole world, right? Including China that was in a lockdown. In this case, if the Americans locked down, China would still be open. So they would be also, I guess, keeping up with oil demand. They won't have storage facilities and, full up to the brim. But a lot of people are looking at oil saying, okay, you know what? This pop here is now pricing in no more lockdowns and is that the vaccine play. Because as I did mention, the US and a few other European countries are beginning now to roll out the vaccine inoculation starting as early as next week, and in Europe's case, the week after. So really interesting breakout here. I do think that this is actually pricing in, as I mentioned, a successful vaccine and no further lockdowns, and just a very important technical break here. for oil. And funny enough, it sort of happened when we were giving our little talk about oil last week and the show before, about if you're, one of these long-term investors, you're looking at oil, you're looking at airlines, cruise ships, banks. Oil just looked really cheap compared to everything else, compared to everything else. Before I pass it on here, let's just finally look here at Bitcoin. It did get that pullback. We did not break into new record highs. In fact, we tried twice to break out into new record highs. And this pattern here is called the double top pattern, where you make pretty much two tops here. And this was mentioned also on our Discord channel with that break below. And we are now we pulled back heavily, and we are now back down to 16,000. So from 19,600 all the way down to 16,400, 3,000, $3,000 in a few days here. And I am still thinking Bitcoin gets one more push lower. And, a lot of debate about this, right? Do you guys think this was a pump and dump, or is this just a pullback in a trend?
Pump and dump.
Pump and dump? Pump and dump?
There was a lot of talk going around, just people saying that this move compared to the last big move was on really light volume.
Mm-hmm. Okay.
So
okay.
that's
so that would be inclined to just a few people taking profits.
You know what I mean? If it's kind of the old thing where if it's moving up on low volume, that gives you an indication that it can kind of also go down if any sort of volume comes in as well. So.
Mm-hmm. Yep. So technically, a lot of these, like I just said, Bitcoin it's hitting a major support zone. So is Ripple. So is Ethereum. Sorry, Ethereum there, and there's Ripple. So I'm just watching this. I'm still sort of on the sidelines here. Again, my case was more about it being an alternative to fiat, but I can't leave out or factor out that whole pump and dump scenario, because a lot of Wall Street guys have been giving their opinions on this move. So still could be play. You never know. I know a lot of people are looking at that as well. So we'll just have to wait and see. And I think if we get that dump here on cryptos, again, the average Joe who was holding cryptos finally got break even, I guess, right? What are they going to be thinking now if this just collapses on them?
There won't be any real sustainable value until banks accept it as a currency, and that's going to be a while from now, and it'll be a lot less value because it has to be manageable. That's my guess.
Okay. All right. So we'll definitely be keeping our eyes on cryptos. But that was some of the market updates that I was looking at. So oil, gold, the dollar, all at important zones here. Same thing here with the cryptos, even while the markets have been subdued a bit for the week.
Alrighty, I'm going to pass it on to TK. I'm giving you a tight 4 minutes.
Thanks, Maddie. You know what? Because you're giving me 4 minutes, I'm going to put you on the spot here. We're going to go through your intimate banking situation, if you don't mind. We'll leave account numbers and SIN numbers out of it. But I just want to ask you, as someone you've probably been banking for most of your adult life, hopefully, and I just want to ask, how do you think banks work? How do they make money? And this is, you've never analyzed a bank, just no pressure.
Everyone must know. I know nothing about this. If I'm about to put my foot in my mouth.
Now go for it.
Scammy. I don't know. At least when I look at just kind of scammy. When I look at I have 2 checking accounts, and one of them, they're like, oh yeah, it's fine, free to open. I was like, this is great. And they just charge me $4 every month. Things like that. Sketchy.
So scammy is the word that comes to mind.
Scammy would be the word, yeah.
It's better than the other S word a lot of people say, so I'm happy with that one. But yeah, it's basically that. I think the product that banks do actually sell is the service behind what they do. So the account is more of a way to get you in the bank. To not sound like scammy, uh, the actual services that they give you are not of much value to you as a customer. It's the value added services outside of that keep banks going. So I want to take a look at the three big Canadian banks or more popular banks because they're reporting their earnings in the period from December the 1st to the 3rd. And there's some, I feel like there's some potential here to get into the banks at a great price, whilst knowing that they are doing scammy stuff on your behalf as a shareholder. So the first one is Scotia. I'm actually a Scotia banker myself. And what I noticed in the last few quarters is profitability has been getting better. And out of the three banks we're going to talk about today, it is quote unquote the cheapest bank. And for most stocks, people use a price to earnings ratio to quantify this. How much are you paying for a dollar in the bank's earnings? And on average, banks are close to 15 PE, or they trade at 15 times their price to earnings. And for banking, that is not a measure we can actually use because of how much the earnings fluctuate from a quarter-to-quarter basis and yearly as well. Banks can go from making $1 in earnings in one quarter to basically not breaking even in one, just because of the stock market moving, their loan portfolio doesn't do well. So the best measure that most analysts use is a price to book. And this is one of the more tangible measures that is easy to understand and it's easy to quantify, because it's a measure of just the current price or the value of the business at this moment compared to the assets that the business holds. These assets being the loans and any investments that it makes, net of anything it owes to you as a depositor. So whatever's left over is what you compare with the two. And Scotia has a current PB of 1.4 compared to the market's or the banking sector's 1.3 average. And I think RBC is close to 2.16 price to book. So you're paying $2 per share for each dollar in book value. And for TD, it's 1.7 or close to 1.7. And it's just relative to the other banks, Scotia is the cheapest, but generally in the industry, it might not be recognized as cheap. You'd rather buy something for a discount than something at a premium. And the reason why I want to make a bet on the Canadian banks outside of the US banks and their influence here is how protected and sheltered the banks are from outside competition. They have been, and I'm probably on record for saying this all the time, the bedrock of the economy. And that goes without saying. Banks have been around since Adam Smith wrote the first book on economics. And this is not to make a bet that banks will always be there. I mean, people have tried to change the banking system, most notably our Lord and Savior, Elon Musk. Before he went to PayPal, he opened up a company. I think it was X something.
Yes, and it bit the dust, didn't it?
Yeah, it did not do well. he couldn't meet some of the herd. There he is, our Lord and Savior in all his glory. And yeah, it didn't go well because the banking system is so heavily regulated, and it just goes to show you it has this competitive moat around it, let alone Canadian banks that are well sheltered from most external factors. Keyword there is most. They're still exposed to a lot of the global economic situations that do happen. It's just they have a very close relationship to the central bank here. And they've tested the trial of time. They are too big to fail. And that sounds like a negative, but for you as a shareholder and someone who uses the bank is always a good thing. And I had more to go on, but the gist of it was as long as you understand what the bank does, and Maddie, you do, if you say it's scammy, and most of it is scams, but you might as well benefit from the scams. You might as well take a dividend of 3% rather than your Scotia account giving you 0.01%. That's, yeah.
That makes a lot of sense. I like that. Okay, thank you. I'm going to pass it on to Colin to wrap us up.
Awesome. So yeah, I was just going to talk about some of the bigger movers for the week, and maybe just see how TK and Vishal feel about sort of how they think about re-entering a stock after a big move, if they think about that. Like, what kind of stuff did you guys look at, say, in a stock like Novo Monde? Vishal, the ticker is NOU. That one's gone up from 20 cents to a peak of $1 from late September to mid November here. So I mean, I'm a technical guy, and when I see these prices kind of coming back down to previous highs and that kind of thing, I'm always interested in re-entering. But what kind of stuff do you guys think that you would be cautious of re-entering or that kind of thing?
I sure to go in here, and probably one of the more controversial things I say on the show. I'm in the belief that a stock price becomes less risky when it comes from recent highs and more risky when it's going towards recent highs. That's my personal belief. So hopefully that answers the re-entry or not exit point.
I thought TK was going to say he bought up here, man. Like, he bought at the highs, but no, I'm just joking. But the number one rule, like, this is what I think for any trading, regardless if it's a Bitcoin chart, juniors mining chart, currency chart, but whenever you get FOMO, which is the fear of missing out, FOMO, whenever you feel that, you have already missed out. So the number one thing is do not chase FOMOs. A lot of new traders and investors do that. They think they're missing out on the move. I mean, Bitcoin's probably a good example. I bet you a lot of people did end up buying at the highs there because the media...
Michelle, I've missed it twice now. I'm obviously not good at it. I've missed it twice. I'm obviously not good at this.
Well, I mean, no, this is where the technicals do come in. Again, nothing moves up in a straight line forever. Price will come back or pull back because people do take profits, which means, the buy orders have to become sell orders. And that can also trigger algos, which will help take price down. And this is why I like to focus on, market structure, right? Where I look at markets sort of like a wave. A wave hits the beach and then it recedes, which is a pullback, and then it makes another approach to the beach. And in this case of Nouveau Monde, I'm sure, Colin, you've probably been watching this zone here, right? A previous support zone. So whenever price breaks out into all-time record highs, that previous high becomes the next price floor. And as you can see here, price is pretty close to that zone. And that's why I think you're probably seeing, buyers enter here and, probably putting stop losses below, because you got to realize trading is a business of probabilities and a risk to reward business, right? So, if you're buying here, you have a nice risk to reward ratio, I would say, if you are targeting these highs, but obviously you'd probably be targeting new record highs compared to, buying somewhere at the highs, right? Then you're placing your stop loss either, as a day trade, really small, or you're trying to get it below a previous low or something, right? So it does become, a risk to reward trade. And as I said, when you are missing out on something, chances are you already have missed out, right? So my lesson, to new traders and new investors is do not give into the FOMO, right? If these markets are always going to be here, there's going to be something else moving, tons of opportunities out there. and don't feel like you've missed out. And if you do believe you've missed out, approach it as an alligator, right? So Marin Katusa uses that term. He invests as an alligator because an alligator can have one meal for an entire year apparently and still stay alive. So they're very, patient when they make their attack, right? So a lot of people call that sniper trading. Marin Katusa calls it the way of the alligator, where he'll see that stock, it might take off, but he's going to be patient because nothing moves up in a straight line and it will pull back, which will give him another opportunity.
Nice. That makes sense. I mean, the line that I've always heard that I liked is that if you feel like calling your friends and telling them about how much money you're making in this stock, that's probably a good indication that you should take some profits. So, but I mean, the big question is always like, after a run, people are like, is it too late to get in? Should I get in? Is the move past? So yeah, I guess nice to kind of hear.
Yeah.
That's actually one of the things that they've tried for so long now to put a quantitative value on, because it's pretty easy to, as an investor, you really have two things you can do: control your costs and control how you react to what the market, the information the market gives you,
exactly,
quote unquote market prices.
Yep.
And for so long now, they've been trying to quantify the second part, the emotional intelligence part of being an investor. There's no actual monetary value or percentage you can put on it, but I think it accounts for a great loss of a lot of investors and traders' returns over a long period of time because of that lack of emotional stability, understanding your own risk preference and risk appetite. It's like simply knowing there's a difference between an ability to take risk and the willingness to take risk kind of thing. It's one of those things you can't measure. Exactly. And sadly, I don't think there is a measure. It's just knowing oneself when you're in the market.
Yeah. So, I've always said trading is like most of it is, I say 95 or 96% of it is emotional and psychological, whereas 4% of it's actually skill, right? It's very easy to learn, like how to trade, how to read charts and all that kind of stuff. But the toughest thing is making those emotional, making decisions, right? When your money's on the line, when the skin's on the game, when you're down a few $100 or $1,000, when you're up a few $100 or $1,000. And generally, that's why I say, if you become good at trading, you become good at everything else in your life, right? Because it really is, you're building habits, you're disciplining yourself, right? You're taking control of your mind. And this is just generally why most successful traders are good at everything else they do, right? Because as I said, they are working on habits, building those good habits. As Colin, you mentioned, right? A lot of people, they'll be up 100 or 1,000% in a junior stock, but they won't take their profits, right? So that goes to the whole fear and greed aspect, where you have to handle those emotions. And when you're in that position, you should be taking profits whenever, in my opinion, right? Or at least half a position off if you're over 50%. A lot of people forget that a lot of the Wall Street guys, right, they make maybe around 18 to 24% a year, right? And they get paid millions of dollars to do so. And it's because they are consistent with their approach, right? They're aiming for consistency. They're not aiming for these home run moves, right? And that comes down again to discipline, to mastering your emotions, focus, controlling your emotions, which is basically what all trading is all about.
Amazing. On that note, I'm going to wrap us up. Thank you so much for watching, and we'll be back next week for more market and scammy bank updates. Thank you.
See you guys.
Thanks, everyone.